makers and market movers. This is The Pulse with Francine Lacqua.
Good morning and welcome to The Pulse. I'm Kriti Gupta in London with the conversations that matter. Here's what's coming up on today's program. Two-year Treasury yields topping 5% as Jay Powell reiterates that the Fed will not hesitate to hike if that's what's needed. Stocks in Europe and Asia following, Wall Street lower. Meanwhile, on the rocks, Diageo's stock falls as the drinks maker warns on profit. Swiss luxury giant in the meantime, Richemont also slumping as it surprises with an earnings drop. Plus, Chinese bank ICBC, the world's biggest lender by assets, hit by a cyber attack, leaving traders and brokers alike scrambling. So let's take a quick look at the European markets map here because, look, a lot of cross currents, a couple of earnings misses that are dragging down the stock 600. You're really seeing that with the red on the screen right here. Take a look at that underperformance from the CAC 40, down about 0.8%. But even right here in the UK, also down by about the same margin. So really seeing some pain across Europe. You do have on some of the kind of the outskirts a little bit of outperformance, but that's really a function of light liquidity, light volume, not much trading. But when you're talking about the earnings stories that we just highlighted, that we're going to be diving in throughout the show, that's where the pain exists. In addition to this macro environment of simply what does a more hawkish Federal Reserve look like? Maybe that dovish pit the markets were pricing in isn't actually at play, and that creates a little bit of a pullback around the world, as we said. I want to get to, of course, those very comments. He spoke at an IMF conference in Washington. Fed Chair Jerome Powell saying that the U.S. Central Bank will continue to move carefully in its bid to tame inflation. The Federal Reserve did not, however, take the possibility of future hikes off the table.
If it becomes appropriate to tighten policy further, we will not hesitate to do so. We will continue to move carefully, however, allowing us to address both the risk of being misled by a few good months of data and the risk of over-tightening.
Joining us for more, Charlotte Ryland, Head of Investments at CCLA Investment Management. She joins me right here on set. Charlotte, a pleasure to have you, as always. Let's talk about these comments from Chair Powell first. The initial take, is this simply him just walking back the market interpretation of the FOMC? Is this as simple as that?
I mean, I think the market's got itself terribly excited, having had that most of October being very depressed and saying high rates for longer. Then, it seemed to sort of say, actually, maybe some of the employment data suggesting perhaps we might be moving back into cuts again. So I think this is just him saying, look, we'll make sure we carry on in this battle. If we need to raise rates, if inflation did pick up again, then we would be doing that. But I don't think it's a sort of a major shift in change.
There was some commentary coming out of JP Morgan as well that simply a lot of the market reaction here is basically stuck between a rock and a hard place. That being, on the one hand, this Treasury issuance that we're seeing a really poor auction overnight in the U.S. relative to some sort of deceleration in the economy that speeds up. What's the bigger issue for you?
I think for us it is about, do we go into recession? That's obviously been the big debate all year. We started off in January and there was consensus that it's going to be a recession. Clearly the US economy has been much stronger than people had been anticipating. But I think some of those headwinds are still there as we move into 2024. I mean, in terms of sort of those COVID savings that people were sitting on, in terms of the impact of higher interest rates and the lags that has. And there are some signs of, weakness in things like the labour market. So it's generally been a pretty benign economy, but that continues to be sort of the big debate, I think, as we move into next year.
Well, when we talk about the weakness in the labour market, and we saw this kind of in the corporate side as well, that because of these really weird cross-currents in the labour markets, these changes in the wages dynamic, it started eating into corporate profits, and then by extension, the amount of investment that you could see on an economic level as well. Is the labour market still the issue here, or are we now going back to this core principle of confusion in terms of whether or not resilience is a positive or a negative thing?
Yes, exactly. It's good news on the economy, bad news because we get rates moving up. I think generally it's been a labour market which obviously got very disrupted by COVID. Participation rates have moved back up for most parts of the labour market, possibly not that sort of over 55 age group. So that has improved. I mean, if you look at Europe, obviously a slightly more complicated picture, particularly in the UK with Brexit and the implications that has had in terms of immigration, etc. But I think that labour market, having been extremely tight, there are some signs that that's beginning to loosen off a little bit, but certainly not, a difficult situation yet.
Well, I think what was so striking to me is when we've heard in the last, I want to say 3 weeks or so, we've heard it from the BOE, the ECB, the Fed, and then the BOJ. But it was the BOJ. No worry, I won't ask you about Japan, but the BOJ commentary was really interesting to me because in his press conference, Ueda actively mentioned not only the wage dynamics in the United States, but he mentioned the Treasury sell-off in the United States as well, as in driving some of the market action in JGBs. And to you, my question is, do you start to see those same issues on the U.S. economy somehow feeding into the monetary policy thinking of the BOE and the ECB?
I mean, I think the UK and Europe are always have an eye to what's going on in the US. I mean, clearly the economic situation in Europe and the UK is already weaker than that. You're seeing that in Europe, but particularly areas like Germany are particularly slowed down. UK GDP numbers slightly better than perhaps people expected this morning, but still not exactly great. So I think, but equally in the UK, we have a much bigger problem in terms of inflation, and that still hasn't pulled back into the same extent you've seen within the US. But yes, what happens in the US clearly drives the rest of the world economy, and what the Fed does will clearly have big influence too.
Yeah, the macro really putting a lot of pressure on the margin story as well on a corporate level. Charlotte Ryland of CCLA Investment Management, she is staying with us. We're not letting her go just yet, but it's that margin story I want to focus in on for a moment. I want to get the latest on 2 disappointing earnings reports, starting with Diageo. Shares slumping after it warned of a pretty steep slowdown in its Latin American and Caribbean division. And in the meantime, Richemont as well, the massive luxury maker, seeing sales of Swiss watches decline. Who better to dive into all of this than Bloomberg's Andrea Felstead? She joins me from Bloomberg Opinion right here on set. Good morning, Andrea. Let's start a little bit about the broader luxury market here. Is Richemont's report indicative of what we're seeing in the broader sector?
Yes, definitely. It's the latest luxury group to say that we are seeing a slowdown from the very strong demands that we saw during the pandemic when consumers spent their lockdown savings, their stimulus payments on Cartier watches, Alea handbags. Those factors are now reversing and they are pulling back. Plus, the Chinese consumer is being much more cautious than many people expected.
At the same time, when we think luxury, I think simply because of that kind of deceleration you've seen for a while, I feel like it's been inborn on both sides of the Atlantic. There's a question of M&A. And in the U.S., we've seen a lot of M&A, Tapestry, Coach, et cetera. In the U.S., in the U.K., and in Europe, we've seen a similar kind of thread with Valentino, with Kering, and some of the trades there as well. There was a lot of speculation about Richemont's role in the M&A space. Now we know that they're selling a stake of YNAP to Farfetch. Is that still on track? Is that still a good idea?
It looks like it. It looks like it is on track. It's a good idea for Richemont. They want to get the losses from YNAP off of their balance sheet. The problem is Farfetch is having a very hard time at the moment. The slowdown in online and aspirational luxury has really hit it. It's got a lot of debt. The worry in the market is that if Richemont wants to carry on with this deal, it is going to have to support Farfetch in some way. That's exactly the opposite of what it wanted to do by selling a stake in YNAP.
I don't know how to make an elegant pivot here, so I'm going to try. When we talk about luxury, I guess we talk about spirits as well. Let's talk about Diageo.
Exactly. You're exactly right. Diageo has felt some of the same effects as the luxury industry in the US because it's those aspirational consumers. They were spending on luxury. They were also going out when they could and spent on pricey tequila and spirits. That's unwinding. But what has caught Diageo out today is actually the Latin America, Caribbean market, which has been a big surprise, I think, for the market.
Yeah, the fact that the growth markets really aren't able to stabilize some of the broader macro story as I think they were kind of meant to in the first place. Bloomberg Opinion's Andrea Felstead, we thank you so much for dropping some insight on those 2 major earnings stories. And like she said, earnings season is in full swing. You are seeing this demand pullback. Let's get back to Charlotte Ryland, bring back in the macro. She's the head of investments at CCLA Investment Management. Look, we've talked about this margin story. Andrea just did a beautiful job of talking about this demand story in the United States as well. Recession has been a conversation 3 years now, 3.5 years now. This feels like an old conversation to have. Is recession the solution to kind of the risk of zombification of economies around the world?
I mean, I think, the confusion we've had some parts of the economy really slowing down, so particularly the sort of durable goods area, manufacturing has definitely had a slowdown. But the services part of the economy has continued to grow very strongly. And part of that, that sort of COVID overhang. Yes, people have been going out buying LVMH handbags, but they've also been going on holidays. Travellers had a great year. Restaurants have had a reasonably good year. So, I mean, that's been that sort of dynamic, that sort of mixture has been going on. And so, I suppose the question as we move into next year is, does some of that begin to slow down? But equally, you could have things like manufacturing beginning to pick up again. I
mean, we're talking a lot about manufacturing. I want to come back to the financial side of the equation, the consumer confidence specifically. In the U.S. at 10 a.m. U.S. time, we get consumer confidence data as well. And we've been talking as well as a lot about the Chinese consumer. And I'm curious how much the consumer is really driving any increase in the global economy that you're seeing, as opposed to it being more production and corporate-led.
I mean, I suppose the stats always tend to look on that manufacturing side, but the US economy is predominantly about the consumer, and that consumer has, despite, the rise in sort of living costs, has been doing reasonably well. China, of course, is in a much more difficult situation. You had that very prolonged COVID lockdown, which definitely has affected sentiment, and you've got their property market in all kinds of trouble. Now, that's not ended up being a sort of US-style collapse that we saw sort of 2007 kind of levels, but it certainly must be a drag on consumer sentiment. That's your major sort of savings pot, I suppose, is those property markets. So those are slowing. That's difficult. And you add into that, youth unemployment is not great either. So that Chinese consumer has not bounced back in the way that people had hoped this year, but it still continues to be sort of a longer-term, driver potentially.
I'm old enough to remember pre-COVID when Chinese data mattered more for the economy, exports, trade deficits, et cetera. And it feels like, to some extent, it held that role when it comes to European luxury. Andrea Felstead kind of talked about where the slowdown is coming from. Is China still relevant to the rest of the economy when some of those trade relationships are deteriorating, when they have this kind of post-COVID policy where the Chinese consumer may mean less to the global economy?
I mean, I think around the edges, clearly we are beginning to shift away from China as the manufacturing hub of the world, but it is still that manufacturing hub. It is still a market of over 1 billion consumers whose levels of wealth has increased massively over the last 20 years. So it is still, a really important market. Yes, it's not growing at the same levels that we saw before, and we've seen companies like Estee Lauder, for example, really struggling in the Chinese market over the last year or so. But is it still going to be a really important market for all of those companies? Yes, it is.
When talking about, I'm going to bring it back to monetary policy as well. And it feels like when you look at some of the data coming out of China, specifically from the PBOC, from the liquidity reserves, from the FX story as well, this idea that perhaps demand for more safer assets like treasuries, for example, is deteriorating. This is a much longer term story. We're talking about fiscal deficits, et cetera, et cetera. Does that matter for the short term story that this de-dollarization narrative exists, this exposing yourself to treasuries exists from Asia, from pieces of the Middle East? Does that matter to your investor playbook?
I think round the edges, and I think the thing with the bond market is it is now at levels where it's actually investable again. Having been for many years, the yields were so low, it just wasn't a sensible place to be. You should be in other risk assets. Now, actually, it is a reasonable place. If you compare that to, say, REITs, or you compare it to some of those sort of safe alternative assets.
You would buy at a 5% 2-year yield?
Possibly so. Yeah, I mean, I think our view is that you would probably come to the peak of rates, short of another inflation shock.
Yeah.
And so, therefore, we've actually got a little bit of value on the table in terms of bonds. So, I think it's part of portfolios again.
The juicy real yield making an appearance. Charlotte Ryland, Head of Investments at CCLA Investment Management, we thank you so much for joining the program. Coming up, the UK economy flatlined in the third quarter as higher interest rates took their toll. We look at the numbers next. Stick with us. This is Bloomberg. The conversations that matter and the insights you need. This is The Pulse. I'm Kriti Gupta in London. Now, the UK economy has flatlined in the third quarter, reducing the risk of a 2023 recession, but maybe suggesting that Britain is facing a period of stagnation. It all comes as higher interest rates take their toll. Joining us now, Dan Hansen from Bloomberg Economics. Dan, this question of a recession, we've been talking about it for far too long. Is it ever going to show up?
It's a really good point. I mean, we've been talking about it, as you say, for the past 18 months, haven't we? And we've had another upside surprise this morning. I think if I look at the data this morning in isolation, it beat what we expected. We expected a small contraction. Am I confident that we're going to avoid a recession over the next sort of 9 months? No. I think we're going to be here having that same conversation, that balance between stagnation and contraction. I think that's going to happen probably until the middle of next year, at which point things might start to look a little bit better. So we haven't changed our view that there are going to be some quarters of negative growth over the next few quarters. And that really hangs from the point that if you look at the underlying data, the underlying GDP numbers, so if you look at consumption, that fell. If you look at investment, that fell. If you look at government spending, that fell. So the economy was saved by net trade. And actually that's sort of not really a strong story to be telling.
Yeah.
What we're telling, the upside surprise here is relative to expectations. That's the sort of good news. But in absolute terms, is stagnation a good story? No, it's not. Of course it's not.
Well, Bloomberg Economics, prior to the print, led by you and your team, of course, had said that there might actually be a chance that we're already in a recession. Can you explain the logic to our audience behind that call? Yeah,
absolutely. So, I mean, if you take, with UK GDP data, you get a monthly path of GDP. So we had July, we had August, and they look pretty weak. We expected a slight fall in GDP in September. We got a rise of 0.2%. So that really was the error on our part. The economy did a little bit better in September. But I think what we're basing our view on, if you take a sort of step back, is this idea that over the past 18 months or so, yes, we've said we've had stagnation, but we've also had very, very sticky inflation. So if you're sitting in the Bank of England, you have to look at the picture and say, what needs to be done to bring inflation back to target? And so for us at least, our view is that you need a little bit, potentially more weakness in the economy to loosen the labour market. And so if you're already at stagnation, the next stop is mild falls in GDP. So that's how the sort of thought process behind our forecasts. It's not the fact that there's been stagnation over the past 18 months. It's the fact that inflation's been very sticky, and that has an implication for the outlook for the economy.
When you look at what is going to be the game changer, what's going to kind of be the straw that breaks the camel's back, so to say, when it comes to the sectoral pieces that make up the economy, whether it's financial services or manufacturing or what have you, what is that? What tips the scales into recession?
Yeah, I mean, that's a really good question. I mean, I think if you look at investment in particular in the UK economy, so residential investment, it's fallen for the past 4 quarters. That's an interest rate sensitive bit of the economy.
Yeah.
I think the thing that concerns, as I said in the earlier answer, the thing that concerns in this particular print is consumption. Because what we had in the third quarter was quite a big rise in real wages. So you would think, my spending power is going up, I'm going to go and spend more money. But actually what we found is that consumers didn't do that, they retrenched.
Yeah.
And so there's a story for the fourth quarter here as well, is that our real wage is going to drive the economy into growth in the fourth quarter.
Yeah.
The evidence of the third quarter is that maybe consumers are getting a little bit concerned, and that potentially stems from the jobs market, where we have seen a little bit of loosening here in the UK. The unemployment rate has picked up.
I mean, it's a lot to digest, and I think the wage story around the world, it's almost, the question is, how much more relevant is it going to become to the broader markets when you do have things like the trade balance, perhaps, to consider and to offset that? Dan Hansen, we have to leave it there from Bloomberg Economics. We thank you so much for your analysis this morning. Coming up, Allianz shares edge up after its giant bond company, PIMCO, helped bolster its third quarter earnings. We're going to have more from the company's CFO on the market outlook next. Stick with us. This is Bloomberg. The conversations that matter and the insights you need. This is The Pulse. I'm Kriti Gupta in London. Allianz shares have edged higher. That comes after its third quarter profit beat those estimates. That all really fueled by giant bond manager PIMCO continuing to attract new client money. We spoke to the company's CFO earlier on his market outlook.
On the macro environment, we see there is, as you were saying before, there is this kind of inversion of the curve, which is about 40 basis points. I'm speaking about the U.S. Treasury curve between the 2-year and the 10-year. This 40 basis point is pretty much stable. Indeed, it was 40 basis point also a month ago. If you look 1 year ago, it was more or less at the same level. So now we need to see what happens clearly. Ideally, we would like to see the short end coming down as opposed to the long end going up. And we will see this is going to be dependent on what the inflation reading is going to be in the next months. Also on November 14th, we are going to have the new reading for the inflation in the US. I'm looking personally at the inflation in Europe. In the case the index is going to be stable in Europe in October compared to the September level, we might see an inflation in Europe which is about 3.5%. So we will see what happens, but if that's the direction, I might expect that we are going to see the curve slowly flattening and more the short end coming down as opposed to the long end coming up, and that will be clearly, from an Allianz point of view, also from a PIMCO point of view, the best case scenario. But as always, we need to see what the economic data are going to be in the next days and also in the next months.
CFO of Allianz, Giulio Terzariol, there speaking about kind of the market dynamics. Remember, they are not only an insurer, but they are the parent company of PIMCO, the giant bond manager, as well. So in addition to watching the inverted yield curve, we're also going to be watching, at least for today, several things on your agenda. At 12:30 p.m. UK time, the Fed Dallas president, Lori Logan, speaking. Is she as hawkish as Chairman Powell is perhaps trying to convince the markets that they are? 3 p.m. UK time, we're getting UMich sentiment data, consumer confidence numbers, probably going to shed a little bit more information on the U.S. economy. ECB's Nagel speaks as well. And at 4 p.m. UK time, Russian CPI for October. Stick with us. More markets, more geopolitics ahead. This is Bloomberg. Two-year Treasury yields topping 5% as Jay Powell reiterates that the Fed will not hesitate to hike if that's what's needed. Stocks in Europe and Asia following Wall Street lower. On the rocks, Diageo stock falling as the drinks maker warns on their profit outlook. In the meantime, Swiss luxury giant Richemont also slumping as it surprises with an earnings drop. Plus, Chinese bank ICBC, the world's biggest lender by assets, being hit by a cyber attack, leaving both traders and brokers scrambling. Good morning and welcome to the Pulse. I'm Kriti Gupta in London. I want to kick it off by diving into some geopolitics here. Israel saying it has struck back at an organization from Syria that targeted a school in the south of Israel with a drone. Now, the IDF did not specify the organization, but did say it holds Syria's government responsible for any attacks from its territory. Earlier, the Pentagon said its forces in the region had come under attack after a U.S. strike in Syria on a weapons depot. Let's take a closer look at tensions in the region with Tina Fordham, who is the founder of Fordham Global Foresight and Geopolitical Strategist and Advisor. Tina, let's start there. This conflict, this risk of escalation in the Middle East, what odds are you putting on that?
Well, the risk of escalation is ever present. I think if we see ceasefires, they're not going to be ceasefires. They're going to be these very brief humanitarian pauses. And that underscores the extent to which Israel is committed to pursuing its agenda of eradicating Hamas. This is very hard to do with a terrorist group. So what that means is that the potential for escalation doesn't go away. The U.S. has moved even more serious military assets to the Med, off the coast of Israel. And not only that, it's telegraphed that it's done so. The emphasis will be on keeping the attacks sort of below radar so that they, or at least below the threshold, rather, of provoking a full-blown military escalation. I think if there is any good news in this very grim security situation, it is that it appears that Hezbollah and Iran would prefer to stay on the sidelines and, perhaps make sporadic attacks. That doesn't mean that this couldn't still get much worse.
Sporadic attacks, but they've already kind of warned. It's almost like their bark is worse than their bite, it kind of feels like. And yet these attacks that you're seeing from the United States into Syria on weapons depots that are allegedly used by Iran specifically, the timing of this is really interesting. Why do you think now is being chosen to target those weapons depots in Syria, of all places?
To limit the potential for a wider regional conflagration. And let's remember, for investors who maybe have forgotten what geopolitical risk contagion looks like, this has the potential to be a systemic conflict. I feel that investors are much too complacent that it remains confined to Israel and the Palestinian territories rather than something broader. Of course, even the Iraq wars had pretty limited geopolitical contagion, but that was against a really different fiscal, monetary, and economic backdrop.
Do you see the defense budget kind of accelerating here? I mean, that was a point of contention while we didn't have the Speaker of the House in the United States, and now billions of aid, I think 14 billion to Israel, I think something like 60 billion to Ukraine. Those are rough numbers. But do you feel like the aid, the defense budget, is going to accelerate here when it comes to the Middle East?
Well, there's the aid budget, and then there's the defense budget, right? So the House of Representatives and all of the political drama there has underscored the extent to which supporting Israel is more popular with Republicans in the House, with a lot of resistance on Ukraine. This, to my view, is a huge risk for geopolitics. The historian Timothy Snyder has said that the best China policy is a good Ukraine policy, and I'm a believer in that. But where, as we look into our 2024 outlook, we start to see this potentially quite toxic, I'm calling it a doom loop, between electoral politics in the United States and even here in the UK, and how to best support Israel and kind of have red lines against terrorism and other sorts of inflammatory moves, starts to interact in a way that is very problematic for aid budgets. I think defense goes in a different bucket. However, the U.S. already spends more on defense than anyone else, and that's not going to change, I think, under any government.
But I guess it imagines where that defense actually goes at the end of the day, which brings me back to the electoral politics that you were just talking about. We've got a general election in the UK due next year. We have, of course, the U.S. presidential election as well. In terms of foreign policy and President Biden's reputation around foreign policy, first in Ukraine and now in Israel, and I would argue in the fall of Kabul as well and the pullout from Afghanistan, do you feel like foreign policy might dictate the election more so than anything else?
Well, I'm going to put it in a slightly different way, because any U.S. pollster will tell you that Americans don't make their decisions at the polling booth on the basis of foreign policy. But what we're seeing, and this is, again, part of this sort of doom loop thesis that I'm talking about, is how the U.S. left, and to a certain extent the UK left here, where, remember, support for the Iraq war under Tony Blair was and still is such a divisive issue. The kind of further fragmentation of the American left could have the pretty paradoxical effect of boosting, for example, Donald Trump's prospects. I say paradoxical because Donald Trump was the person who instituted a Muslim ban during his time in office. And the idea that the left's divisions over U.S. support for Israel, and as well as concern about the policy to support Palestinians in Gaza, might actually affect turnout from Democrats, is an important one. And it is, just another wild card in a 2024 U.S. election, which isn't going to look like anything we've seen before.
I love that you mentioned kind of this electoral piece of the equation, because if you look at protests from around the world, they are happening. I think we are, 6 weeks into this war, or 5 weeks, and going on week 6. Every single weekend in every major capital of the world, you have seen protests for both sides, obviously, but a massive kind of pro-Palestinian turnout in the United States that I think a lot of people didn't necessarily expect to see in the United States. I'm curious in terms of the turnout when it comes to other wars like Ukraine and Russia, for example, or other issues around the world. Is this the distraction that Vladimir Zelensky says it is?
I'll use a different terminology, because you are quite right to draw the contrast between the uproar, particularly, but not only on the left, about sort of military support for Israel's actions, compared to, who has seen large-scale demonstrations in support of innocent civilian Ukrainians? What does that tell us? It tells us that the Middle East conflict is a lightning rod for global public opinion in a unique way, right? And I think that that's for investors, for business leaders, understanding the extent to which it galvanizes public opinion in an already fragmented landscape and can act as a driver changing election outcomes is extremely important. I mean, U.S.-China relations are poor. U.S. public opinion about China is poor. It has a modest impact at the most on voting behavior.
And that doesn't even begin to describe some of the pain points with Saudi Arabia, for example, and the issues there as well. Tina Fordham, sadly, we have to leave it there. I'm so sorry. I wish I had a whole hour with you. She's, of course, the founder of Fordham Global Foresight and a geopolitical strategist and advisor, joining us right here on the Pulse. Now, as she was talking about, the Middle East has always been not only, as she put it, a lightning rod for geopolitics, but also a lightning rod and really a global crossroad for air travel as well. And that's where I want to go next. Now, rising tensions forcing airlines to add extra miles to flights as planes skirt around those war zones and potential conflicts as a safety precaution. Bloomberg's Kate Duffy has the story. She joins me right here on set. Kate, a pleasure to have you on the set, on the program. Talk to us about how the approach has changed when it comes to air travel in light of this conflict.
Yeah, so many airlines have stopped flying to Tel Aviv since the escalations last month. And there's no sign that they're going to reopen these routes until the conflict settles because of passenger safety. And this has made it ultimately harder for airlines to fly in and out of the region. But the situation depends on each airline. So for some airlines, for example, Lufthansa, they've stopped flying to nearby cities like Beirut because the violence is still strong. But other carriers such as Ryanair and Wizz Air, they've reported a slowing in demand in the area. So they've relocated their capacity to other regions of the world. So we're really seeing this big shift in operation in airlines. And the situation is even more tricky because of the Ukraine war and the consequent Russian airspace ban. And it means that airlines have a difficult choice to make when flying around the world because there are less options for them in terms of flight routes.
It's interesting that we talk about that, and you mentioned Ryanair as well. Ryanair, just off the top of my head, I think canceled something like 900 flights to Tel Aviv alone just in the month of October. To what extent is it eating into their bottom line? I mean, we know this is maybe the flight routes themselves are longer, but how much damage is it doing to some of these companies?
Yeah, I mean, more time in the sky means more fuel burn, and that ultimately leads to higher fuel costs, especially in the current environment. And it makes it more expensive for these airlines to fly to the destinations that they serve if they have to fly around these banned airspaces. An extra hour of flying can cost more than $7,000. So, I mean, if they have to reroute, it's a big decision to make. Now, they can do. Some airlines, they could fly around the Middle East, go north and cross over Azerbaijan, or they could go south and cross over Egyptian airspace. But it's not a simple fix. It adds on a lot of hours to the routes, and it costs a lot more money too.
What does hedging look like in then? Because if we're talking about not only geopolitical risk that's going to push up oil prices, as it did off of this conflict, but to the point that this is going to cost an extra $7,000 an hour, it sounds like hedging is the way to approach it.
Yeah, absolutely. And airlines do have their oil hedges to some point. But in the current situation, obviously, fuel costs are high, and that creates ultimately a higher ticket for the passenger as well. So we are seeing a lot of market share going more towards, for example, Chinese airlines instead of potentially European airlines because they have shorter paths and they can cross over Russian airspace because they're not subject to Russian airspace bans like the likes of European carriers. So yeah, there's a big shift in airline operations and all sorts.
It's certainly something we're going to be keeping a very close eye on, of course, as this conflict and the risk of regional escalation increases. We just had Tina Fordham talking about that. It's this kind of omnipresent issue that a lot of investors and corporate leaders alike are thinking about. Bloomberg's Kate Duffy, we thank you so much for walking us through that story. Now, I do have some breaking news for you. Italy's FTSE MIB stock index does not seem to be updating. Looks like that's coming straight from the Borsa Italiana, basically saying that the value of the index itself is not bringing us the current numbers. Now, we don't have much else yet, much context yet on what that looks like or what the reasoning is. But of course, that is the headline that we are seeing right now. We will bring you more information right here on Bloomberg Television as we get it. But for now, Italy's FTSE MIB index, the stock index, not updating. Now, coming up on the program, AstraZeneca joins the weight loss drug race. CFO Aradhana Sarin discusses plans to develop a cheaper obesity pill. We're going to bring you our interview next. Stick with us. This is Bloomberg.
For the last 4 decades or so, globalization has powered the world economy.
After the end of the Cold War, what really accelerated was the economic integration of big nations.
As I signed the North American Free Trade Agreement into law, we are ready to compete.
What made sense for businesses from a profit motive standpoint, from a cost and efficiency standpoint, was generally also supported by governments when it came to developing really complicated supply chains around the world.
The more countries work together, the more their economies are linked, the more likely they are to be at peace with each other, and that therefore is good for the world.
We're clearly not on that path anymore. There's a lot of uncertainty about what is ahead.
There is a group of economies who are navigating the middle of this geopolitical divide. You can call them the connector economies.
It's a rethinking of globalization and to some extent of regionalization, and it changes everything.
A look there at Bloomberg Original's latest documentary exploring what they're calling the Great Fracture. You can watch the full video on Bloomberg.com, YouTube, or on your Bloomberg terminal. I want to get to some of the other top stories we are following on the Bloomberg terminal. Novo Nordisk is to invest more than $6 billion, expanding its manufacturing facilities amid soaring demand for its weight loss and diabetes drug. The company's, the Europe's most valuable, says work will begin this year on the 170,000 square meter factory at Novo's existing facilities in Denmark. Now, the blockbuster drugs Wegovy and Ozempic will be among the medicines that are produced. Over the United States, West Virginia Senator Joe Manchin has announced he is not seeking re-election next year. His decision now makes it difficult for the Democrats to keep a Senate majority in 2025. In a statement, Manchin hinted at a potential presidential run as a third-party candidate. He's widely seen as the only realistic chance for Democrats to keep the seat in Republican-trending West Virginia. Back here in Europe, Portugal will hold a snap election in March after Prime Minister Antonio Costa unexpectedly resigned earlier this week. Costa is facing a probe into possible government corruption. Now, the president says lawmakers will be able to give final approval to the outgoing government's 2024 budget. General elections were last held early in 2022, and former Prime Minister denies any wrongdoing. In Spain, acting Prime Minister Pedro Sanchez has reached an agreement with a Catalan separatist group for the votes needed to form a third government. The deal was part of a broader negotiation to pass a controversial amnesty for hundreds of activists who were involved in an illegal independence referendum back in 2017. From geopolitics to the corporate space, AstraZeneca is joining the weight loss drug race, saying that their potential pill could be cheaper than Ozempic or Wegovy. CFO spoke with us about the company's plans to develop an obesity pill.
Obviously, we had a very strong quarter in the third quarter, but we also increased our guidance for the year with a few months to go, just given the strength we're seeing. So we increased both our EPS guidance as well as our total revenue guidance ex-COVID. There is a lot of excitement around the obesity space, as you know. The current products on the market are both injectable products that are available. And the license agreement that we did with Echogene is for an oral GLP-1. This is still early in development. It is in phase 1, and we expect to take it into phase 2 towards the end of next year. Because it's an oral molecule, it's obviously easier to manufacture, and we hope that over time, most of the market, as more oral products come into the market for obesity, the market will transition to more oral. When we did surveys and we talked to patient preference, more than 2/3 patients obviously would prefer an oral product. So we think there's a lot of potential in the obesity market.
Aranda, good morning. It's Guy. What do you think is having the biggest effect on the stock today? You're up by 2% and a bit. You're pushing the FTSE 1 higher by around 14 points. But I'm wondering what you think that is. Is that your great numbers? And is that your guidance change? Or is it the fact that you're doing this in obesity? Because as you say, the buzz is there. I'm curious as to how you're kind of thinking about how you're going to drive share price forward at the moment, and to what extent this decision to get into this space was a kind of precursor to that.
So I can't really speculate on the stock price, but I think it's a combination of multiple factors. So clearly, it is the results and our performance that has not only been very strong in third quarter, and as I said, we raised guidance, but consistent over the last several quarters and last several years. I think secondly, it is the strength of our pipeline, broadly speaking. So if you think about it, we have about 120 phase 2 and phase 3 studies ongoing right now. We've had several positive trial readouts this year. We have several regulatory approvals, and we expect to continue that momentum into next year. So it's the ability really to replenish the pipeline and continue launching new drugs. And then thirdly, while the license that we did for this GLP-1 is interesting, it really builds on the cardiovascular, renal, metabolic area that we've actually been pioneers on for many decades.
The AstraZeneca CFO there on developing those obesity drugs. In the meantime, a U.S. unit of ICBC, the world's biggest bank by assets, has been hit by a ransomware attack. We're going to bring you the details next. Stick with us. This is Bloomberg. Now an update for those of you who are watching the Italian FTSE MIB index. It had stopped updating briefly. I'm now happy to tell you that it is resumed updating. And of course, we had a brief moment there with the FTSE 100 and 250 as well, but looks like that has resumed updating as well, according to Bloomberg data. I want to go to one of our other top stories here. The world's biggest bank by assets, ICBC of China, has had its U.S. unit hit by a cyber attack, forcing it to use a messenger carrying a USB stick to carry out some of the trades. Bloomberg's Jenny Surain is all over the story. Jenny, very quickly, what do we know?
Yeah, I mean, this is one of the world's largest banks, and they have admitted that they know that there's a problem in their U.S. unit. It's delaying some of the work that they do on the market side. And, they're still investigating and trying to get to the bottom of how exactly this happened.
Do we know who's behind it?
So we have sources telling us that it's Lockbit, which is a criminal gang out of Russia that has actually perpetrated similar attacks on other financial services firms. You remember Ion earlier this year. So definitely somewhat of a known entity, but I think we're still kind of waiting for more official statements on that.
And can anything be done to prevent this in the future?
It's such a good question. I mean, every single bank CEO, when you ask them what keeps them up at night, they usually say cyber. So I think, they'll keep spending billions, and these hackers and fraudsters are usually just one step ahead. So we just have to keep spending to hopefully stay ahead of that.
Maybe one day they will. Bloomberg's Jenny Surain, we thank you so much for that update this morning. Folks, stick with us. Up next on Bloomberg Television, Bloomberg Brief with Danny Berger in London and Manus Cranny in New York. Programming you do not want to miss. Stick with us. More markets, more geopolitics ahead. This is Bloomberg.